Wake up in the morning, feeling the weight of the world on my shoulders. I wanna move closer, but I don't control it. I know I've been trying, the door isn't open. I know it sound funny, but really though, in the beginning we really close. Now we just cruising up on the coast. Don't wanna lose you, I really don't. My God, I'm working so hard. I let my guards down and I'm feeling so far. You won't cut me off and I'm ready to grow and I'm ready to know you more. Please, I honestly say I'm mature. It ain't my decision, it's yours. But I will persuade with my arm, cause I'm ready to run to your arms. I just want you to know that I wanna go to a place where I find you, a place I call home, a place where I'm not alone. And maybe I'll grow just a little bit more, and I'll be adored. Then I'll be adored. Then I'll be adored. Then I'll be adored. Then I'll be adored. I go back and forth when I feel your presence. I'm above the world. There isn't much better, but then I fall levels and levels below it. Don't know where I'm going, don't know where I'm holding. I say I gave up, but I know I didn't. It's just my frustration, I'm only human. I act like I know what I'm really doing. As long as it's you that I'm really choosing. I will never give up, no, I wanna do it your way. You're the king of the world, only wanna do what you say. I know that it's possible to give back my heart to you. Do it that you choose. I just want you to know that I wanna go to a place where I find you, a place I call home, a place where I'm not alone. And maybe I'll grow just a little bit more, and I'll be adored. Then I'll be adored. Then I'll be adored. Then I'll be adored. Then I'll be adored. I know that you love me, I really do. Just wanna do right by you till it's through. Please don't ignore me, please just adore me. Wanna be closer to you. I just wanna make you happy. A shining light looking right at me. I give to you gladly, that's my reaction. I just want you to know that I wanna go to a place where I find you, a place I call home, a place where I'm not alone. And maybe I'll grow just a little bit more, and I'll be adored. Then I'll be adored. Then I'll be adored. Then I'll be adored. Then I'll be adored.
Okay.
Welcome to Parents and Pennies, where family meets financing and every dollar counts. Brought to you by MITM Business Consultants. Join your hosts, Art Abrahamian, with over 12 years of experience in finance, banking, and business advising, and Roy Rosales, a father of two and coach to many, who has an extensive background in real estate. These two family men are here for you, bringing real stories, practical tips, and financial wisdom every week to keep your family thriving. They'll help you secure your family's financial future through simple, memorable financial adjustments that will help you achieve your financial goals. Because when it comes to family and finances, it's not about having more, it's about making the most of what you have. Here's Art and Roy.
What's going on, everybody? Episode 12 of
Parents and Pennies. I'm joined here with two lovely people, Roy and Rciardo. What's going on, boys? How are you?
I'm truly blessed. More importantly, how are you both doing?
Doing phenomenal. Just being with this gentleman here.
There we go. Well, it's going to be exciting today.
Yeah, actually, today I'm taking a step back. I'm going to let these two professionals, good morning, Vietnam. Somebody say good morning, good morning. I'm taking a step back today. I am going to let Rciardo and Roy go into it. The title of this was Real Loans, Real Families, and these two gentlemen on the forefront of getting people into homes have identified some issues, and those issues being that a lot of families don't know what options they have when they go to purchase their home, refinance their home, and all the other accoutrement of things that are out there. So Rciardo was the one that reached out and was like, hey, how about a podcast about this? I said, sounds good to me. Roy said, yeah, let's do it. So I'm going to let you guys take it over. Rciardo, what are we here to talk about today?
Well, first of all, again, thanks for having me, and it's good seeing you, Roy.
Yeah, it's amazing, man.
I will say I remember the 4-second hug, and I know sometime during the podcast that's going to happen.
Yeah, no, most definitely it is. As we get to know each other a little bit more, again, it's a hug starts staying a little bit longer, squeeze a little bit harder. It's just a huge relief. And believe you me, this is the second time we're seeing each other, and that hug is only gonna get a little bit longer and a little bit harder.
This is like the we won't sleep together until after dating for 2 weeks thing.
Something like that, right?
Yeah.
Let's get to know each other first.
Yeah, absolutely. That's how you know when you're in. I go, man, like I'm looking for the hug. But to answer your question, we're gonna talk, like you said, about families and loans, and really give some wisdom, some knowledge on how to maneuver the complex world of lending, specifically mortgage lending. Mm-hmm. And I know with Roy's tremendous and extensive experience, I know we can shed some light to families so they can make informed decisions, and especially if they're looking to get pre-qualified or really have the dream of owning a home.
And I believe it's just giving someone hope, right? Giving someone hope is going to allow them to feel that it is possible. And speaking with the right people, speaking with the right person, and helping along the way, that is what brings the hope, the light, and you become a light in their world. That's what we want to be. And that's where today you will shine some light into the qualifications, the do's and don'ts. And, it's not really hard, right? It's just you got to make proper steps for us to reach that goal. And are you willing to? At the end of the day, we're here to help you, walk you through every step, but you got to do the work, right? And so can't wait. Let's talk about it.
Yeah, and before you guys even get going, I want to emphasize that Rciardo's extensive knowledge in the world of what he does goes beyond real estate. So, where I met Rciardo, if you guys don't remember from the first podcast, is this was my mentor when I worked at the bank. But not only that, like he is a former financial advisor as well. Years in underwriting, banking, lending. So, anybody listening, this isn't just, and no offense to anybody who takes it that way, but this isn't just your standard run-of-the-mill, oh, yeah, I'm in real estate, I work for a brokerage firm. Like, no, this is he's been on both ends, the underwriting side, the loan side, the advising side, and now he does this. So, it's a wealth of knowledge for our listeners today. So I'm going to let you guys go ahead, and I'll probably chime in for a couple stories here and there.
Okay.
All right, Roy. So where do we start? For me, one of the first things that people come and ask is, I want to qualify for home. What are my first steps? And I love that question because it's that saying, if in order for you to embark on a journey, you got to know where you stand. Mm-hmm. And where you stand, then it'll determine what are the steps, right? It's no different than, I love the example of losing weight. How many pounds you want to lose? 100? Well, how much do you weigh? And then you draft a plan from there. So on my side, step number one is it's really talking about credit.
Okay.
How's their credit? And we can dive into that. So these are the big topics: credit, income, and as income relates to their liabilities, in other words, what payments they had, like car payments, and then how do all those items play together? So their credit, their income, and the liabilities. So those are the main topics. That's what people ask me. But what do they ask you? Roy, I know you're in real estate. Sometimes you're the first person that sees that family before they even get to a loan officer like myself.
Yeah, always a good-looking person first, right? No, well, the first thing is, like you said, credit is what will my credit need to be for me to qualify? And now I'm asking you, what would be the credit?
Awesome. So it'll depend based on the loan type. So, for example, most people have heard, if they haven't, they'll probably can just type on ChatGPT or Google, what are the loan types? And they'll see two main things. They'll see an FHA loan and they'll see a conventional loan. And those loans have different guidelines, different rules, if you will. So, for example, a conventional loan will require a 620 FICO score.
Damn, they lowered it.
Right.
It used to be 640.
Yeah, so 620. And with an FHA, we can do 580, which of course is lower than 620. And believe it or not, you can also do less than 580 on an FHA. However, it will require a 10% down payment.
Got it. And 10% out of 500,000, we're looking at
50,000.
50,000. So that way everyone can do the math, right? So even at low as 580, you could qualify for a home.
That's correct.
Okay.
Now, I will say this, and of course, this is not a sales pitch, but the reality is that you can, in fact, qualify, but the terms are not going to be favorable, Roy. They're going to be, what do I mean not favorable? Say you're at a 5.8 or higher, you might get say, I'm just going to throw an example number, 6.5 FHA, but if you have a 575 FHA, then you might get like a 7.5 because you represent higher risk, right?
Yep. So, and that's where, again, real loans, real families. We
That's
are
right.
here to discuss the reality of this. We're not going to paint it like Mickey Mouse it. We're here to really disclose the reality of it, right? The lower the credit score, the higher the risk, right? And the higher the risk means, more bigger interest rate or bigger down payment.
That's right, or both, because, and people sometimes ask, well, why is that? And I'm only 5% shorter than the 580. Well, that represents, it's, credit, and in the essence speaks of, character, collateral, capital. And so that's basically, it paints a picture. The lower the score, it means, doesn't make somebody bad. Trust me, I've had really good credit and I've had terrible credit, and I'm still the same person. Just life happened to me, right?
Yeah. So, different chapters of our lives. So okay. So now we talked about the bare minimum, which is 580 or something less or something a little bit more than that, but you're still coming in with a higher down payment. But let's go into, hey, I have a 640 credit score. What does that happen?
Before you guys do that, I actually want to chime in. So I like what Rciardo was saying, where it's like, oh, I'm only 5% short. And it's like the equivalent of like, well, I'm 20. Why can't I come into the bar at 20? I'm not 21, but I'm 20. It's like, right, you're 20. Come back when you're 21. And for those of you listening, when Rciardo started talking about credit and collateral and character in lending and finances, there's something called the 5 C's of credit, right? And I haven't heard somebody use that in so long, where it's so funny that you did, where it's like the 5 C's of credit, right? It's character, capacity, capital, collateral, and conditions. And I had to look it up because we only know the first 3. We forget what half the other ones mean. But, even in the lending world, especially because this is one of those worlds where it's like, it's not your first car. This is your first house. This potentially, they say it's not your forever home, it's your first home. But for some people, this is their forever home. So understanding, the guidelines. And when Rciardo said the minimum credit score, I did the nastiest stink face ever, because it's like, I can't believe that it's down to 580 and 620, because back in the day, not even back in the day, 5 years ago it was 640. So it just goes to show, with the national credit score average continuing to plummet, meaning more and more people have terrible credit, that they've even adjusted the credit minimums to support that. So anybody who's like, they make it harder for people, regular people, to get a home, I want you to remember that they've had to continue to decrease the minimum required score to keep up with how bad everybody's credit is. So next time you're complaining that they don't make it easy, just remember a minimum's 580 now.
Yeah. So going back to that on the, what if someone does have a 640 credit score? What would that look? I know we need to look into debt to income ratio and all that, but what would they qualify now in that perspective?
So before I answer that question, again, I want to make a reference to what Art said. My background of being a financial consultant, as financial advisors, financial consultants, we're like doctors, right? We ask plenty of questions. Tell them about your habits. Tell them about your, again, back to the whole example of losing weight, because people can relate to that. How much do you sleep? Or how much do you eat? What time do you eat? And so in the financial world is the exact same thing. Before I tell them, okay, you have a 640, I don't automatically assume that a conventional loan will be the best thing, because I need to know about other factors like, okay, tell me about what kind of money do you have? What kind of down payment? Well, what is your job like? Do you have a cyclical income because of your job? Or do you get royalties from your job, and who else is going to be living there with you? Do you have family members? So once I have an idea of all those aspects of the client, then I'm gonna juxtapose, compare and contrast an FHA with a conventional. Why? Because I want people to understand. I want people to learn. It's the saying, I don't want to just give them the fish. I want to teach them how to fish so they can fish for life. And I strongly believe that, because I've been in the financial world a long time, but I made plenty of mistakes because I should have learned better. And I'm not blaming nobody, but if somebody had taught me those concepts, I believe I would have made even better decisions. So to answer your question, there's a lot more that goes into that.
Of course. But for this particular reason, at 640, would they qualify for a lower down payment?
With a 640 on a conventional, they can count on a 5% down payment.
Okay.
And depending on the income, like I said, I will need to know their income and where they're they're thinking in applying. There's some Fannie Mae loan limit guidelines that they can potentially get along with as little as 3% down, either 5% or 3%, depending on the area where they're buying. And just to expand that more, so I live in Ontario, and in that area, the median income, say if you make $140,000 a year, you exceed that minimum income. So I would not be able to qualify for a 3% conventional in my area if I've made that kind of money. So it depends on the income that somebody makes. So 5 or 3%.
Okay. Well, that's good to know. Anyone, with the credit score, if like I'm at 580, I'm only 60 points away from, qualifying for something like that, which, again, what would make things a little bit better? Getting the 10% down or getting the credit score up?
So what I've seen statistically, it's easier to get a credit score up than getting the money down, because, I mean, you've seen credit. So in fact, there's one quick example is credit utilization. If somebody has a credit card limit of, let's call it $10,000, and they're using 60 or 70% of it, meaning 6,000 or 7,000 of the 10,000 is being used, that's actually impacting their credit score negatively. So the moment they decrease that, say they have $20,000 in their savings, if they were to pay that down to 30% or less, so in other words, they went from 7,000 to 3,000, that will have a positive impact on their credit score. They may go 10, 15 points. So they may be at, say, 619. Now they're all of a sudden they're that 635, 645, and now they qualify for a better term. So credit is the easier way to handle as opposed to coming
Saving
out with.
Up. That's good. That's a great note for someone that thinks, I need to save or I need to pay down my credit card before I even try or get information. And that's what you're here for, is to provide that information. And then the next thing you talked about was, the debt, or in that terms, and the other word that you used was liabilities. Tell us more about that. I know you just discussed about the credit card, but tell us more about what does that look like? What is debt?
You got it. So anything that shows up on your credit report, a lot of times people are concerned, my electric bill is $200 a month. Well, lucky for us, we don't have to count that as part of a liability, a lot of debt. But say a card note, a card payment, minimum credit card payments. If you co-sign somebody for a car loan, that's going to count against you. There are ways to mitigate that, remove that, but it gets complicated. But to answer your question is car payments, credit card payments, personal lines of loan payments, anything that shows up on the credit report would be a liability, a debt, something that will impact the purchase power of the person looking to buy a home.
And I think when you talk about strategic, right, because that's now going to my world of like advising, and it's like, okay, the strategic aspect of it also factors in what's cheaper, paying the credit cards down to get the additional 5% off, or is it actually cheaper to just pay the 5% more than it is to pay the credit cards down and get your score up? Because there's also that avenue too, where it's like you have to look at what all your options are, and Roy always says it's about having the right team behind you. But you know, when you have somebody like Rciardo who can run a scenario and say, "Hey, it would cost you $30,000 to get these credit cards down to where we could give you an additional 3% off, you know, the down payment or 4%." But then we have to look at, well, how much? If it's going to cost me $20,000 to get $10,000, does it really make sense at that point? You're better off paying the extra 10 and then spending another 10 to pay down your debt and kind of meet in the middle, where it's like these options, and you don't get that from most either. You know, you talk to a realtor, the realtor won't give you tax advice, and if he does, he shouldn't. You talk to Rciardo will give you lending advice. You come to me and I'll give you this advice, but it's very few groups where you come in, you're like, hey, this is my tax guy, this is my advisor guy, this is my realtor, this is my broker, and like collectively we will come together and paint a picture. You know, I've worked many deals with Rciardo where that's exactly how we work together, where he's like, I'm not a tax person, Art is. I'll give you the scenario and you can talk details with him. But the point is, the people that talk to Rciardo and myself get more detailed instructions and what if scenarios than a lot of other people who just go to, you know, a different person who does what Rciardo does but doesn't have the background.
Yeah, and in a lot of those times, right, anyone that's doing this for the first time, they don't know what to ask.
Right.
What are the proper questions? And that's what we are here to do, is to let them know what questions to ask to those professionals, right? So we can get those answers. And I'm glad you brought that up, because a lot of times people say, I can't afford a house. Well, let's take a look at that debt, because now you have a $700 car payment, you have $400 of credit cards, all those stuff, and you're like, well, that's why I don't qualify for more. Yeah, but if you pay those off, look how much is you brought that up, purchasing power. You know, tell us a little bit more about that, because that makes, I mean, if they have a $50,000 car loan, how much does that reduce on the purchasing power, more or less?
Yeah, so let me give a live example. I'm helping a family right now, and through a life event. Their point is that they need a home. It's a mom and two children, and one of the children or the boy, the son, he's already of age. He has a job, and he's helping mom to buy this home. He has a car payment. He bought a regular car, you know, I don't know, Honda Accord, $35,000 car loan note. Payment is, his credit score is not so good, so he's paying me $700 a month.
We just did one. Remember, when I was telling everybody in the last, because this is a great segment. Podcast prior to this was used new cars. And I was telling everybody, I'm like, don't be surprised if your $30,000 car cost you God knows how much. I get calculated.
$12,000 a year.
Oh, that's more than, that's your 12, you know, because we said the national average is 12,000 a year, and everybody's thinking, oh, that's on a fancy car. You said 700. Yeah, it's 8,400 a year on that car. But when you factor in, he's probably on a 60 month. So 84 times 5. His $35,000 car is costing him $42,000.
Yeah.
And so, yeah, very real, right? Real families, real loans. And to answer the question, if they did not have this car payment, they would qualify in this example specifically based on their income, $475,000. But because they have this car payment, now they only qualify for $425,000. So that we're talking about a $50,000 difference.
Okay.
And now that's impacting the kind of home that they're getting, the neighborhood that they're getting, all those different variables. So, and again, with such a competitive market, being able to have more purchase power gives them the freedom to compete and negotiate, right? If they're already maxed out at $425,000 and the seller, I mean, this is your world, they want, $450,000, then they can't. They're out of the race.
Yeah. No, well, that's great to know because whenever I always ask, what's going to be more important, the car or the house, right? Because the car will drive you there, but it's not the house that you want. You're not going to be able to buy it because now it reduces $50,000 to $100,000 of your purchasing power. Now, when you want the house in this city, now it's going to be on that other city, 30 minutes away. Are we sure, right? And I think that's very valuable. I had one client. We told him that, and the next day he went to go sell it. Like, nope, I prefer the house versus the car.
It's perfect.
Which is, again, it's just, what are you willing to do? We're here to give you the answers, but what are you willing to do with that, right? Now, the other programs, I know you talked about FHA, conventional. It's like, what are the first-time home buyers right now? What are the programs right now? Are there any programs for first-time home buyers?
Oh yeah, that's a whole podcast in and of itself, Art. So there are literally hundreds of first-time home buyer programs. Now it depends where you look and who's helping you. And for example, representing the broker world, we are partnered with hundreds of organizations, and I'm going to use right now the Cal HFA, which is the California Housing Finance Authority. They just rolled out a program. It's a down payment assistance program that is specifically called My Access. If you look up Cal HFA My Access, you can get the details. But basically, in essence, you can get down payment help on an FHA or conventional, the 3.5% down. You can get that as a down payment. And then you can get an additional 2% for closing cost. So you're getting like 5.5 to 6% of down payment help. So some of the requirements for a first-time home buyer would be they have to be, of course, a first-time home buyer, meaning that they have not owned a home in the last several years. If they own a home already, obviously they don't qualify. But then there are other down payment assistance programs for first-time home buyers. They can literally check with their local banks wherever they live, whatever they bank. Just because banks also have, they set money aside, and Art knows about this. Banks sometimes, because of the CRA, Community Reinvestment Act, they are asked or obligated to invest in their community, so they'll set money aside for first-time home buyers. And then you can also, people can literally just Google first-time home buyers in my area, and they'll get a list. Now, just because they're there, they'll need somebody like you, somebody like Art, myself, to help them decipher, which one really is the right for me, because otherwise it's information overload and information constipation that's not good.
Yeah, no, and getting your information from the right person is gonna help you through the craziness of buying a home, right? And you talked about going to a bank. We're real people, real life, real relationships. I'm gonna be real. I've had bad experience with banks. Lenders, there's some bad experience, but banks, holy crap, I have had bad experience. Meaning I've had buyers go with their bank, and then they're telling them they're approved, but then next thing you know, 14 days in, they're not really approved and they can't really qualify. And now that buyer lost the inspection money and the appraisal money. And that bothers me because they're just a number into the banks. So when I say get information from the right people, is really speak to the source, which is, in this particular case, you're the source of the lender, and getting that information right away, and that we can close on this deal. Because if you say yes to a house, you're saying yes to a couple other things that you need to put in money with. And that, for me, bothers me, that a bank will tell you yes just to get you in. And then next thing you know, hey, you really don't qualify because we just now ran your credit and you do this, or you didn't report enough in your taxes last year and now you don't qualify for this amount, even though you tell me you made this a month, but you're reporting this. So that is something I don't like, surprises.
I hate to take this position, right? And Rciardo, I already hate to take this position, but I will say, coming from our perspective, step back, the problem is we go with what you tell us.
Yeah.
And if you walk in and you say, I have a 700 credit score and I make 30 grand a month and I make this, that's what we based our figures off of. That's how I would do all my applications. That's how Rciardo used to do all his applications. That's how he does them now, right? People don't have, and this comes from more of like a lack The problem isn't in the banks. The problem is in the schools. The problem is in the lack of information, because a person who brings home a $60,000 W-2 thinks that that's their income. And yeah, on W-2, technically that's your gross income. But when you really break it down, we go by net. We don't go by gross. Whenever you're doing any sort of lending application, it's the net proceeds that you take. That's why I have business clients who make $30 million and can't qualify for anything, because the net that they report is $2,000. So you're saying I need a $500,000 line of credit with a net income of $2,000. There's no way that that income could support that level of debt. The problem stems from the lack of information, right? And it goes, we preach about this every day, every week, but the reality of the situation is this. It's like you said, you went in saying, oh, I have a 700. That person says, okay, based on these figures, these numbers, this is what we've got for you. And then the deep dive analysis starts. That's where we say that you look beautiful outside the dress, but then when you let us take the dress off, it's like, okay, now we see scars. Now we see these tattoos that you didn't tell us about. Now we see this. Now we see that.
Well, I love how you went to that analogy, man.
But the point being where it's like, I can't think of anything else right now.
Got you. I would have said peel the onion, right?
Yeah,
but okay.
See, here's the thing: when you peel the onion, it has 20 layers, but under those 20 layers, it's still an onion.
Yeah.
So you're getting the same thing, just different versions of that thing. When you're talking about finances, it's more complicated than just that. That's why the conversation shouldn't go based off, well, here's what I make, but I don't actually know what I make, right? There's a lot of pre-work that needs to be done before you even go to the bank. And that's where people like Rciardo and myself and you go, hey, before you just go get something from the bank, why don't you pull your credit report, see what your average percentage utilization is? Why don't we see what you're working with your taxes? Why don't we see what you're working with your payments? Because then we can do like a pre-adjusted so that there are no surprises. But again, without that information going out there, how do you know, right? And I myself, who at the time of working for the bank, got a loan, FHA, through my own bank. And you would think, well, he works at the bank. I had 2% debt utilization at the time. I had a 780, 790 FICO. It still took, I actually was involved in my own home purchase because for whatever reason, they saw a banker's title. They thought I wasn't the buyer or whatever. If I didn't force the paperwork through because I'm like, here's it all done. Like, why are you guys still standing on this? What do you need? Here it is, here it is, here it is. And then I started doing all the work. Even as close as I was to the lender, underwriter, and not personally, but I mean just like in proximity, that I could just email them because I was in the same chain of employees as them. It still took me 5 months in difficulty. I'm like, guys, it's not that hard. It's a W-2 income. I have no credit to worry about. Debt is nothing. Credit's great. So it's like, that's while you're in that circle of stuff. So, that was the day I realized that it's not meant to be easy.
Well, I wanted to go back a little bit about what you said, Roy, and thanks for chiming in, Art. The reason I said going back to the banks is because it's about getting that information, right? I think that it's, getting perspective from both sides. Because I represent broker world, and there's people, even the other side of me, that says, well, how do I know that this is the best loan? Well, I happen to know that because I have friends currently after 20 years of banking experience that work at banks, and we call each other and say, hey, what are the rates? What are you guys charging? What's the cost? So I know that broker world is extremely competitive, but people that just meet me, they don't know that, right? So I go, go to the bank, ask them these questions. What are your first-time home buyer programs? What will it take? What does my credit score need to be? Will you give me a pre-qualification or a pre-approval? And then I'll explain what that means. And then I'll say, then you come back to me, and then we'll compare. And that way, I think people will find the information for themselves, and they'll come to a conclusion of what's better for them, right? I'm not here to impose what's better for them. I'm here to give them the information. Now, I will agree with what you said. From the lender point of view, I will say I'm a lender. I've had real estate agents that come, Rciardo, like, I don't want to go to like this bank or that bank because they lost my client money. And the reality is that, as an independent loan officer, this is how I make my livelihood, right? So I better do a good job. I better make sure that I follow through for people. Usually, and we worked at banks. I worked at it's not mystery. It's in my LinkedIn. I worked at Wells Fargo for over 19 years. I had a salary. So whether I sold a checking account or did a line of credit or not, I got paid my salary, right?
Yeah.
And in this world, it's different. And if I have a bad reputation, guess what? People are not going to come back. So that's the difference. The effort put in from a loan officer at a broker world, it's higher. And it's not always the case because sometimes people will sell you. So what is my advice to people? With social media that we have, I mean, literally look at people, see their finances. I mean, not their finances, see their LinkedIn, their social media, kind of get to know them, right? Because it really is about that. Like, I think people are intuitive enough where if they know you, Roy, they'll be like, yeah, this is a good guy. Like, I can tell something about you because who you are shows up over time.
Oh, yeah. Yeah. You can't fake it. You know, real people will find out how real you are. And, you know, you just talked about the couple differences, right? Is your effort and your energy into making sure that this happens versus a bank, right? They get paid regardless. So that's another difference between a pre-qualified versus pre-approval, which you talked about. What Art was talking about was a pre-qualification. It's a verbal. I make this much. This is my credit. That's a pre-qualification. Pre-approval, I submitted some of the paperwork. They already verified some of the things, right? So that's the difference. Why? As a realtor, if someone submits an offer and I'm helping the seller and you submit an offer with the pre-qualification and another offer with the pre-approval, that's going to be the difference of why we go with the other offer, with the pre-approval. Because the pre-approval already went through a couple of the things, meaning observed and got the documents, got the verification of employment. If that's already in there, they already looked at your credit versus what you assume that you have, which is a pre-qualification. So there is a difference of those two, which you can probably elaborate right now, but hopefully I answered it. But that's what, for me, as a realtor helping a seller, I'm looking for those things. And if you don't have those things, then that's not a clean offer.
No,
What was some of the reasons for the pre? And I'm sorry to cut you off. I'm just now my wheels are turning. What is some of the reasons that those pre-approvals got declined? The only thing I could think about with a pre-approval getting declined is contingent upon information, right? So it was a pre-approval contingency, meaning if like they pulled your credit and they saw a car payment coming out, but you said, I don't actually pay that car payment. What is it? 12 months, right? If you can prove 12 months of no payment, then it's an add back.
10.
Okay. So it was 12 back in the day, but now it's.
So the difference is technically that wasn't a pre-approval. It was a pre-qualification.
Well, don't they offer pre-approvals with contingencies?
There's always conditions, right? However, a pre-approval, you already verified a lot of those things. That's the difference between pre-qualification and pre-approval.
So then I guess what I'm asking is why
they were pre-qualified.
Oh, you're saying you've never had a bank pre-approve and then come back on the.
That is correct.
Okay.
That is correct.
I that's why I was like, what happened during the, because that's the only thing I could think about for the pre-approval getting kicked back.
When another possible, and I say possible because, there's so many there.
Yeah, of course.
Another possible reason, even with a pre-approval, so I can show you my phone. People call me on Saturday, Sunday. Hey, Rciardo, I need this pre-approval yesterday at 8 p.m. Went on my computer, done. You call a bank, you're not going to call a bank. Well, you can call a bank on a Saturday, Sunday. They're not going to answer. Yeah. So Roy needs to meet timelines.
Friday.
And with a pre-approval in the bank and a pre-approval in a broker, they're just not going to meet the timeline because of the business model that they have.
Yeah.
I'm so glad that you brought that up, which is another bonus part of the lender part, right? Is there is a difference between getting the information in a timely manner, right? So if I have a very hot listing and it's very hot, a lot of people are looking at the property Thursday, Friday, Saturday. Sellers accepting an offer on Sunday night. You cannot wait till Monday to call your bank and be like, can I get a pre-approval? By that time, the house is already gone and you missed the opportunity. So always go with someone that is going to answer you on a timely manner, because that could be the reason why you don't get the house that you want.
Yeah.
What does McQueen say? Speed.
Yeah.
Lightning McQueen.
Yeah. No, that is so true, because sometimes you're like, I'm going to wait. Well, someone else at this moment right now, it is 10:47. can be submitted an offer at any property and gets accepted within the next couple of minutes.
Yeah.
And now you're like, oh, really? I thought it was slow. No, not for the right properties.
Yeah. I mean, that's the thing. So, like, we've talked about a lot of the, perfect scenarios. I think a lot of people listening, and I want to address the average person who's listening going, well, that all makes sense, and that's all fantastic, but I'm not in a position to even do any of that, right? Because that's where people get turned off on this whole subject altogether. It's always been I'll never be able to. And I hate when people say that, because it's like what most people pay in rent is about what they would pay in a mortgage. Yep. That's just how it is. It's just prepping yourself, right? So it's like you may want a house. If you want a house within the next 2 years, then there's 4 years of prep that, I always just say double the prep work. Mm-hmm. So if you think you want to be in a house in the next 2 years, then give yourself 4. Spend the first 2 years prepping and then spend the next 2 years finalizing the prep, because you also have to adjust and factor inflationary costs, right? Because the money of today is not the same money of tomorrow, and it's definitely not going to be the same money of 2 years from now. So if inflation outperforms your capital, then you have to now spend an additional timeline trying to keep up to make it back. Or you could be in such a great position that deflation actually appreciates your funds rather than depreciates them. So it's just don't, everybody would say like, oh, well, you guys are talking about just paying your credit cards down and then you'll qualify for this loan, but where am I going to get the money to pay these credit cards down, right? I get that all the time in comments. I get that all the time when I talk to people. It's like, these are perfect scenarios, but how do we get to that point? And that's where, if you've been on the Parents and Pennies podcast and you've been watching, everything we talk about may not be what you need to hear today, but you can always go back to one of our episodes, and that will be the stepping stone that'll get you to this podcast, maybe even 2 years down the road. So it's about budgeting. It's about understanding utilization. It's about, again, just because we have a podcast that comes out today, that's not your push to go get a house tomorrow. Mm-hmm. These are simply just VODs that you can go back and look and say, you know what? Today's podcast inspired me to start the process. In the next 5 years, I would like to live in a home.
Yeah.
Fantastic. So let's go back to episode 1 and 5 and 3 and 4, and let's learn about credit. Let's learn about savings. Let's learn about budgeting so that we can start implementing those things so that we can, in the next 4 years, come back to episode 12 and do it. And then by episode, the goal is we want these podcasts to be the steps to life. They might be in different orders. You might have to go from episode 3 to 7 and 10. And it's like the Star Wars series, you don't watch it 1 through 7. You watch it like 6, 5, 4, then 2, 3, 1. We're the same thing, right? The idea behind it is more so just, we're talking about these things today. They may not apply to you today, but don't use the conversation and topic of today to stop you from getting to this point tomorrow. Yeah. This is simply the stepping stone of just having you understand that this is coming from a lender's perspective, a realtor's perspective, and a consultant's perspective of like, these things all meld and amalgamate together. They are a savings, credit, budgeting, debt to income, collateral value. There's a million factors that go in, and utilizing this is really, I just wanted to emphasize that, because I've been told that they listen, they get excited, and then, they get disheartened because they're like, that's never going to be me. It's like, it will be you. Roy has shared with us his experiences and stories, how he went from $70,000 in debt, bad credit, to homeowner, no debt, and Rciardo and myself, we've gone through some things as well where it's like debt, especially when we left the banking industry. We were kind of like, hey, dude, what's it going to take to make $20? Yeah. We have a question. It looks like we have a question for Roy and Rciardo. Have you had any interesting interactions with people who were purchasing undeveloped land and looking to put a trailer on the site while developing? Is it the same flow?
Yes and no, right? When you buy, from my perspective, right, from what I've known, if you buy a land, it's cash. It cannot be financed unless you get the blueprints, unless you get the contractor, unless you get the proper checklist that the bank requires for them to loan you that money for that you're going to do a construction.
Yeah, and most banks don't even do construction loans now. You have to get a construction loan through a separate party, And then after the house is built, then the bank will take it as a refinance. So there's that to factor too. But I think the question that this person's asking us is like, if I buy land and then I wanted to buy a manufactured home or because now trailers kind of out. It's more manufactured homes are becoming more popular. I know that for a fact because a lot of developers are now using like it's cheaper to just get a $200,000 prefabbed home delivered on the property. So I guess
maybe I can chime in. So undeveloped land, right? So like Roy said, you can either buy cash or now we step into the world, what is called the non-QM, non-qualified mortgage loans. In that case, I know some banks that will lend you, say the land costs $80,000. If you have 30% down, then they'll lend you the difference at a 9 to 11% interest rate. Now, the key here is undeveloped land. Now, fine, you have the land. This is raw land. Now, you want to buy your trailer, your mobile home, whatever you want to call that. The technical term is after 1976, it's a manufactured home. Before 1976, it's a mobile home. Now, you're going to run into these factors. This is where Roy and I can help you. Right? So you have the land now. Well, there's no utilities. There's no septic tank. There's no sewer. Well, you cannot just like do bathroom on the yard. I mean,
every home came with a shovel.
Yeah. So you got to think about those aspects. How are you going to get your water, your well, and yeah, you can rough it out and maybe just buy your land somewhere where nobody really knows you, and you can create your own sustainable workplace. But it's not approved by the municipalities, by the cities, and it's just a matter of time where you get caught and then you get fined and then you're out of your mobile home. And yeah, you own the land, but it's not tradable. It's almost like one of those Pokemon cards or whatever.
Yeah.
You have it, but if nobody wants to buy it, like what?
Yeah, you have a very expensive paperweight.
Yeah.
Well, that's where if the other comes in, a 433A, which is a mobile home on a permanent foundation, then it can be qualified as a loan. The interest rates are going to be a little bit higher, but now you qualify to buy that particular mobile home that is on a permanent foundation with the land. But if the land doesn't come with that mobile home, then it's not on a loan. It has to be cash.
So if it's an empty land, maybe we can ask Titan here to kind of elaborate. I guess the question is more for the land or putting the trailer on the land. That way we can get Roy and Rciardo to specify more in depth.
Because even you buy the land, right? And you buy the mobile home, and you have to you're not going to have 200 cash. You're going to have to, get the loan. That interest on that mobile home is going to be really high. So you talk about.
Yeah, they're 9 to 11% average.
Yeah.
On the land or the home?
The home.
Not including the land. So even if you bought the land cash, because it depends where you buy it too. I mean, you could buy a piece of land for $30,000, but then hooking it up to septic, electrical, water, it's like another 15, 20 grand.
Yeah. And now if you, I gotta, I guess, define, when I say 9 to 11, I'm talking about a mobile home. But if you do what Roy was saying, a manufactured home on permanent foundation, then the rates can be better, but then you're going to run into back to the issues of utilities. If the home doesn't have them, then no lender is going to finance that manufactured home, even if you're willing and able to have it done. You got to work on those aspects first.
Because the appraisal won't pass.
Correct.
Oh yeah, I'm glad we got this question, because now it's like, this is a person who's like, hey, this is what my thought is. So, okay, while we wait for him or this person, whoever this is, to type out a little bit more descriptive, what would be your recommendation? Pretend you get a call like this and they're like, hey, what if I buy land and then I buy a trailer and then I do this? Then what would you guys advise? What is an alternative?
Same thing. It's like, all right, so fantastic. I love that idea. I love what he said at the beginning, hope. We give people hope, because when there's hope in the future, there's power in the present. So I go, great, let's find out what makes you want to do that? And then how much money do you have? First two questions. And depending, if they say, I have no money at all, I just kind of want to live in the wild because I'm a man. Then I go, sorry, let me, I'm a man too. Let me take you some manly.
Yeah.
Give you some manly advice. Don't do that.
Well, that would be the first thing. And where are you getting that information from? Who told you that was cheaper? That's what I will say. Who
Right.
said that was cheaper?
Because it seems like that's where a lot of people think, oh, that is where it's cheaper. Because
Wait.
that's why we're seeing such a surge in non-conventional home buying, where it's like people are buying buses and converting the buses into homes. And it's, I feel like when you're in a city, like I actually know somebody who lived in LA and he bought a boat instead because the rent that he was paying to be on the dock was like $600 a month. And then the boat payment was like $1,500 a month. So he was living in LA on the water, literally. When I say on the water, I mean on the water for less than $2,000 a month. But that was because his only other alternative was like double the cost for barely any quality. And it looks like so in the past, this seemed like a more viable options than trying to rent or purchase a property. The average rent in California is $2,750 with an average income of $41,901.
Well, yeah. You talk about that rent, $2,750. For $3,000 a month, you can own a home, right? And it all depends, of course, of the city and how much are we willing to drive, but that you get a chance to own a home. That's where the opportunity comes in. Is like you get a chance to do that. Is that what you want?
I guess because that breaks down to an average monthly $34.91 pre-tax. How does someone make that work? Okay, I get. So I think what he's saying is like everybody was talking about doing the undeveloped land, buying a trailer, because even if we could get a home for $3,000, the average monthly pre-tax take home was $34.91.75, which would be like 90% of their income into a mortgage payment. So I guess even in today's market, is buying an undeveloped piece of land and throwing a trailer on it going to solve this issue of not having enough?
Well, just like if we had $150,000 in the bank, I think, yeah, you may have an opportunity because you still need to put the electricity,
Right.
the water, septic, and then not only buy the trailer, but have it moved.
Right.
Buy the land, get the permits. You got to have that cash.
Right. Even on something that you think is cheaper, you still need all the money to back end cover it.
And this is where it gets exciting because, like you said, we tap into a different world. If somebody has this kind of money, then there, for the listener or person that asked the question, there's some loans where they're called, for example, this particular lender, they call it their community loan, where if they will place 25% down, plus they have reserves, then the lender, the bank, is not going to ask them for how much money they make. So they literally can get a home if they have 25% down.
On stated income?
Yeah, and then they can get creative, which a lot of my family members have done this, converted their garages, and then at that point, if they own a home with land, then they can start doing what they were saying, like they bring the trailer and they connect.
Sure.
It gets exciting.
But that's having cash in the bank. If this person asking the question says, okay, well, I have no cash in the bank and this is my idea, where it's like, I'll buy land and put a trailer on it. It's like, no matter what, it's still going to cost you a lot more than what you think, because not only the land purchase, then the trailer, then if the municipalities, like Rciardo said, even allow for such a thing. So I guess in that scenario, then with your guys' opinion, what's the best thing for them aside from talking to somebody? Because it's like they might think that it is a cheaper option, but it is a cheaper option maybe in the long term, but it's a subpar option during the entire process, where it's like you're going to spend about what you would pay down to get this going and then still have the upkeep cost, monthly costs, and it's only going to save you a fraction, I guess.
Exactly. Getting that information, education, that's what's going to allow you to make the best decision possible for you and your family. And that's what we are here to come in and give you those options and that hope. Okay, what you're telling me what you want, this is how much it's going to cost you. But look at the other opportunities. Take it with you and go think about it.
Yeah.
Because if it is going to cost you $150 just to get the land and the mobile home, but in this particular case, in FHA, is going to only cost you $20,000. The conventional is only going to cost you $40,000.
Yeah.
And you get a home. Which one is better for you? That's where I will say, that's where we want to get that information.
Right.
And then make that educated decision for you and your family. And I always suggest to everyone, meet with your realtor. Interview realtors first. Because the reason why is the realtor is the gap, the bridge to the lender. And for me personally, that's where we will get to know each other a little bit better.
Question for you, Roy. It said, Roy mentioned making a commute. Is there an ideal distance to be considered near civilization without costing an arm and a leg?
Oh, yeah. I mean, 30 to 40 minutes. Nowadays, 30 to 40-minute drive is nothing, realistically. So I think 30 to 40 minutes, you give yourself an opportunity to be a homeowner, to still have your nice car, and still have the job. But now you give a security to your family and to yourself. That, to me, is, worth it. Now, again, building the equity, building an opportunity that in 5 to 7 years from now, things may change. You know what? I want to be closer. But now you built equity on that house. You can now sell it. And now whatever profit you make, you can put that as a down payment next year. But before we even go there, we talk to the lender. Hey, lender, how much would I qualify if I want to buy it over here? Right? Or how much do I need to make in the next 5 years for me to come buy over here?
And how much do I need to report?
Exactly.
Because making is one thing, reporting is
exactly.
another.
So all of this right here, the conversations need to be still active for your next chapter of your life.
Yeah.
So that's why having the right people in your team, in your side, in your corner, is gonna make the difference between of you getting to your dream home, getting to you're always having hope versus, you see, I don't qualify. They told me no, but they didn't give you an answer. They didn't tell you why. So I don't know what would you say to that, Rciardo?
I mean, just to answer that question, I've helped people look at homes as a lender for example, in Victorville area, and they work in, they have family members in West Covina area, so that's like about an hour drive, and they've made it, but with the purpose of, like you said, to make it like a short term, because long term is very tiring. My own brother did that.
Commute.
I mean, my brother bought his house in San Bernardino. He was driving to Norwalk every day at 5 a.m. He did it for almost a year, and then he was like, all right, I'm done with this. So it is definitely a way to get started, but, you know, to each their own. In my opinion, I think it's a good short-term plan, but long-term, you can't be driving forever. You know, it's tiring.
Sure. And I think to piggyback off that, too, from a perspective of, like, finances, where it's like, if it's short-term, like your brother probably didn't net positive out of that year interaction, right? Like, I imagine that he ended up, when you break it all down, lost. Buying in San Bernardino, spending a year there, gas, commuting, depreciation on his vehicle, wear and tear, and then probably didn't make enough in capital gains on the equity on the home to justify that. So sometimes, even if you're like, well, it's a temporary solution, well, how temporary is temporary? Maybe it's best not to do it at all, and instead of living in San Bernardino, sleeping at mom's couch for another year and stacking up that money to make up the difference. That's why when it comes to finances, and I think we can all agree, it's such, one question has 70 different answers, because one question has 70 different strings that come from it, where it's like, if we look at the, you know, going back to the multiverse of like the Avengers world, where it's like, you know, there's that tree and there's a million different timelines of how these things could happen, where it's like, you have to understand, you don't make short-term plans on a long-term item. And mortgages, 30-year fixed. Cars, they're kind of in the middle. It's a 5 to 7 year, but you don't want to make big financial decisions if you're not prepared to be there for at least 30% of the life of the product, I think, is a fair number. If you're not willing to stay in that house for 10 years, then it's not worth getting for 1 year. Unless you get it for a steal, and it's like, okay, I'm going to definitely make money on that. But I think that anything else you guys want to talk about? We're about an hour in.
Maybe more, I know the two gentlemen talk about mindset, and I've followed you for some time. And on my side, I guess closing thoughts would be, I mean, it really is hard. I mean, there's no way, no doubt about it. It's hard to buy a home or be a homeowner, but there's also a saying that says, well, life is hard and being a renting is hard. So you got to choose your heart.
Yeah.
You're going to choose hard being a renter, or you choose hard being an owner. And then it takes a plan, and that plan takes discipline. And I've had to have part-time jobs. You know, I mean, I'm a banker, Mr. Banker, AVP, right?
Yeah.
And leaving that world, and then I had to, at some point, I was driving some Lyft, like temporarily. People are like, you're crazy. My dad was like, what's going on? Like, aren't you like, I go, I don't care that. I have a plan. And if I need to make an extra $500, I'm going to do that. But I was willing to put my ego on the side and say, I don't care what people say. This is for my family. And I think this is what I find a lot of times people are not willing to do that. So if you're coachable and you want to listen to the experts, it's that hard. It's not as hard. But if you don't listen, then fine. You're so I don't know how this is going to come across, but you're not going to own. You got to listen.
Yeah, I agree. I think that's anything. If you're not willing to put the ego aside, and we talk about all the time, humility. If you don't have any humility and you're not willing to put your ego aside, if the long-term goal is to own a home, then the everything that leads up to that is how do we own it? What does that look like? And what do you need to do to get to that point? If that, Rciardo, perfect example, where it's like, I'm sure the people that sat in your car had financial conversations. You're like, man, if only they knew who was driving their Lyft right now. You know what I mean? And it's like,
well, talk about what's important to you, right? You talk about goals and the sacrifice, like, and being coachable. Like, sometimes we got to do things that we're not excited about, but we need to do it for us to reach that milestone. You drop the biggest weight of your life, but the people that I know, the whole thing that you did, not everyone can do, but you're like, I'm going to do it. And you sacrificed a lot.
oh, yeah.
Right? You sacrifice a lot, and look where you are now.
And I still sacrifice
Of course.
to this day because I can't sacrifice everything and then go back to bad habits because then I'll just end up back where I started.
Exactly. But that's the thing is, what are you willing to do that you're going to be more grateful for?
Yeah.
Right? And you're going to enjoy it more. And also, like, why do you care what they think, especially if it's negative? What, you're going to buy a house all the way over there? Yeah. Do you own? No. Then why are you giving me advice on that?
Yeah, it's always
right.
the advice given is always by people who have no business talking.
Or this is the one that I would say for me bothers me when another homeowner tells a buyer, "Oh, wait till the market goes down." Well, you could wait because you have a house. They don't.
Yeah.
And look what happened in 2020 when people were qualifying. They're like, "It's gonna crash." 5 years later, now you're $200,000 that you have to pay. So whoever gave you that advice, tell them you owe me $200,000.
Yeah.
Like, that's real,
Yeah,
bro.
it's true.
And now you're like, F this, right? Like, damn, I should have bought it. I'm like, yes.
I remember the advice I got given, and we'll wrap this up, but I remember the advice I got given. If you're always waiting for the next thing, you're never going to accomplish anything because by the time that next one comes out, there's already word about the following thing after that, where it's like, do you need it now? Then just get it done now. You might win, you might lose, but again, are you buying this home with the intent of absolutely demolishing and winning and this, or are you buying a home because you are done renting and you need a home? Yeah. Now, again, I've seen some 800 square foot homes in my area buy for $500,000. I'm like, that person's out of their mind. I would never buy something like that. But then again, it doesn't matter what I would do because like you said, I have a home. Maybe that person's like, at this point, it's either this or nothing. So again, I would never go to that person and say, hey, you made the wrong mistake because that person obviously
needed it.
Went in there with like, you know what, it's 800, but if the land's big enough and maybe if I save up, I can turn 800 into 2,000. Yeah. Because sometimes it's just getting the thing and then everything after that is part of that long-term plan. So it's one of those things where it's like, I think what you said is great. Listening to people tell you not to do something. If there was this magic ball that told us everything we need to know, we'd all be billionaires. The reality is whether the market does crash, doesn't crash, will crash, won't crash, who knows? But if you're just going to wait, you're now gambling with your livelihood. And if you could afford it 5 years ago, you might not be able to afford it today.
Exactly. And that's what it is. But at the end of the day, hopefully this inspires you. This gives you hope that anyone can be qualified just with the right people in your life can help you with everything. So that's for me, and that's everything I have to say.
That's it. Thanks, Roy. I love how you were asking all those questions. I can't wait to maybe have a different one on different topics. This is like intense. It's a lot.
Yeah.
It's a full-time job.
Oh, well, people don't know, man. It is full-time.
It's what goes in the back end. That's what people don't know.
It's
but
not 9 to 5. It's not 9 to 5. It's
24/7.
We got to be available.
Yeah. 24/7. I mean, I want to thank everybody for listening. I want to thank Rciardo for coming out. I want to thank Roy, as always, for carving time out to provide information with me to the community. Rciardo drove an hour to be here, so we always appreciate him. And want to thank everybody for tuning in. This is episode 12 of Parents and Pennies, and we will catch you on the next one.
Let's go.
Thank you for joining us on this episode of Parents and Pennies. We hope you found our tips and insights helpful. Remember, it's not about how much you have, it's about making the most of what you've got. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share it with other parents who could use a little financial guidance. Join us next week for more real stories, advice, and the financial wisdom you need to keep your family thriving. Until then, keep making those pennies count.